Good morning and welcome to the CG Asset Management Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Sophia Sednawi. Good morning.
Good morning. Thank you so much, Alessandro. Good morning, everyone. Welcome to CG Asset Management's Q1 2025 webinar, and what a quarter it has been. I'm here with Alistair Lang and Hassan Raza from the fund management team. But firstly, I'm just going to quickly draw your attention to our disclaimer. Essentially, the value of investments can go both up and down, and nothing we say this morning should be considered as investment advice. So Hassan and Alistair are going to talk about what's happened over the last quarter, changes to positioning, and as well as the outlook as we see it. So the data shown in the deck we're going to run through refers to Capital Gearing Trust, but obviously the views expressed this morning apply to all of our fund range, whether multi-asset and fixed income. You can see the full list of funds on this slide. And last thing before I hand over to the team, I just wanted to draw your attention to this. We revamped our quarterly reports at the start of this year. We now have something called the CG Insights Report. We sent it out to our distribution list on Monday, so hopefully some of you have received that. If you don't, do let us know if you want to be added to that list. You can also find it on our website. We'd love to hear your thoughts if you have any. Now that is enough for me. I'm going to hand over to Alistair and Hassan for the main presentation.
Good morning, everyone. Thank you very much for joining. My name is Alistair Lang. I'm Chief Executive at CG and also Fund Manager. So I have the, I don't know if it's enviable or unenviable task to talk a little bit about the current environment. I'm looking at the outlook, but just keeping up with current events is quite a lot all of itself. So I'm going to spend 10 or 15 minutes talking about what's going on in the policy, macroeconomic and capital markets. And Hassan will talk in more detail about portfolio developments. And I'm going to start at the only place that makes any sense at the moment, which is around tariffs. The imposition of tariffs on Liberation Day have caused some of the most dramatic moves in particularly equity markets, but really across a number of markets that I've seen outside October 2008 in my career, which raises some interesting questions, really. One of which is, given quite how well flagged the tariffs have been, why has it come as such a shock? I mean, so Donald Trump was talking extensively about tariffs during the presidential campaign. He talked about it after his election to the presidency, and he even had the pithily named Liberation Day flagged well ahead of time. And so the most time he was talking about it back in October 24, he coined the now infamous phrase that, to me, the most beautiful word in the dictionary is tariffs. That was at the Economic Club of Chicago in a quite competitive interview he gave with John Micklethwaite, the editor-at-large with Bloomberg. And you can see the Guardian coverage of that, very widely covered conversation, suggesting that Trump is proposing at least 10% blanket tariffs on all imports, with tariffs as high as 60% on goods from China. And I actually went back and read the transcript of that. And he really was remarkably clear. I mean, Donald Trump says a lot, kind of flooding the zone in Bannon's words, some of which is transpires to be true and some of which doesn't. But it is remarkable how clear he was about his intentions on this point. And I guess what's interesting about that is that in October, November, December, the equity market was in what could only be described as a melt up rather than a meltdown. But this was when everyone was being made aware of what was going to happen. So what is it that was announced that is so much worse than this, so much worse than what everyone had apparently anticipated? Well, there are a few potential contenders, one of which is the way that the tariffs themselves have been calculated. We've got here Donald Trump's famous sandwich board of tariffs on the left, and a formula released by the Office for the United States Trade Representative on the right. And, you know, a lot of, at least historically, a lot of trade negotiations are really excruciating line by line kind of reviews on all kinds of regulatory, tariff and non-tariff barriers. But the approach taken here has been totally different. There's rather a beautiful looking formula there, which you know, the T stands for the level of tariff, the X minus N, M, the numerator there is essentially the deficit with America's deficit with the country, and the denominator is essentially the elasticity of trade. And essentially what it means is the larger the deficit the larger the deficit that America runs with any country, the higher the tariff rate. And it doesn't actually necessarily relate to any of the tariffs that the other country has put on. So to take an example with Vietnam, you can see that's third on the sandwich board there, 46% tariffs being put on Vietnam. That is against a claimed 90% tariff that apparently Vietnam is levying on American goods. So Vietnam is a 500 billion economy. It exports to America about 140 billion of goods, and it imports from America about 15 billion. So it runs about 125 billion trade deficit, which is getting on for 25% of GDP. So that tariff, 46% tariff alone, is about 10% of Vietnam's entire GDP. So the reason why Vietnam has a very large trade deficit with the US is principally because it has organized its economy to provide the kind of consumer goods that the Americans want. And its population simply does not have the money to import anything like the scale of American exports. It's just not possible under any scenario. So, I mean, Donald Trump's not known for his consistency, but there's something about this formula that says if it is applied consistently, it essentially means these tariffs are not a passing phase, but they're here to stay. And I think really that has been part of the concern, the sense that these tariffs are not a short-term negotiating ploy, but they're certainly going to be around for at least the duration of Donald Trump's presidency in some form or other. And history suggests that these things tend to hang around. Biden certainly didn't repeal Donald Trump's tariffs from the first term. So there is that sense. However, even that can't be such a shock, given the guy had already made clear that he thinks tariff is the most beautiful word in the language. It cannot be a surprise to anyone in the financial markets that the tariff rate was going to be higher than it was historically, and it was going to be remain that rate for at least the duration of Donald Trump's presidency. And it might have been a surprise to Wall Street, but it wasn't so much to Main Street. The reality is there were a number of slowing economic indicators pretty much from around the time of the election. We have here a couple of consumer survey data from the University of Michigan. You can see on the left that US consumer confidence was slowing quite rapidly. This was ahead of Liberation Day, and US inflation the consumer inflation expectations for a year ahead had actually gone up quite significantly. And this is something that is looking really quite stagflationary. So it appears that Main Street, or at least that portion of Main Street that fills in the University of Michigan surveys, which must be quite a distinct portion of Main Street, but they could see that that there were challenges likely to hit the US economy, and that the economic data was already showing signs of slowing. I think economists have now been rushing to downgrade their forecasts. If we look at American growth in particular, I note that Panmure has put a 30% chance of a US recession this year. I think JP Morgan had their expectations at around a 60%. And I note that Larry Fink mentioned in an interview recently that he thinks the US is already in recession. So it seems likely that a sharp economic slowdown is underway. How deep that will be remains to be seen, but something quite stagflationary, quite possibly a shallow recession occurring at some point over the next 12 to 18 months seems really quite likely. But it's quite hard in the midst of the kind of movements and turmoil that we've been seeing to get a complete analysis. But I really think a large reason for the scale of dislocation in at least the US equity markets comes not from where we've moved to, but actually where we started from. We wrote at the beginning of the year in our last quarterly that US equities were priced for perfection. We flagging quite clearly then slowing economic indicators and the risks associated with tariffs coming in. And it was quite extraordinary that PEs were approaching 30 times. Current year PE multiples are by no means our favoured way of thinking about valuations, but it is one kind of shorthand. And other than the everything bubble in 2021, which was accompanied by zero interest rates, valuations on US equities were looking very close to all-time highs. So they have moved quite a long way in the recent sell-off, but I don't think anyone comparing the kind of 22, 23 current year multiples that they're at would say that US equities look cheap even after the last fall. The average PE ratio over the last 20 years, and indeed going back to 1950, is about 18. And we've seen in most recessions, you can see here on this chart in 2020 and 2008-9, with the two recessions in this period, you've tended to see PEs drop well below 15. So I think part of the reason for the incredibly stark performance of equity markets is because at the end of last year, we really saw the last bull go all in, and there just weren't really any other buyers. Certainly, we have been skeptical about US equity valuations, and as we look at the markets today, we are not tempted to jump in at these levels. So we'll have to see how things transpire, but we fear that there is, if we are heading into a recessionary environment, that there are further for these markets to fall. There is one corner of the risk markets that looks slightly better, at least in a relative sense, and that is the investment trust market, the main market that we look at. We're looking here at through the lens of discounts, which have been blowing out across both conventional equity and alternative trusts since 2022. So looked through this kind of prism, investment trusts were kind of are and have been for most of the last 12 months sitting at somewhere near cyclical troughs. So it has been a period of underperformance over the last couple of years as a whole. The investment trust index has underperformed the MSCI World. But that has somewhat reversed over the last quarter, with investment trusts outperforming, and we are reasonably confident that that this part of the market has still quite a lot of capacity to outperform in a relative sense, given where discounts sit today. And Hassan is going to talk about some of the detail, but one of the things that occurred in the quarter that I was going to talk a bit about, but now seems very much like yesterday's news, was the activity of SABA, large amounts of value players who are coming into our space. We've seen new IPOs looking to exploit these kind of discounts, and I think there is real relative value available in the investment trust space. Although we would point out in absolute terms, if the US market has further to fall, that returns could still be relatively muted, even if in relative terms they are likely to be better. The other area that we've seen some reasonably dramatic moves has been in the bond market. And essentially, I would sum this up by saying we've seen a real steepening of the curve. That is to say, as economists have rushed to downgrade their economic forecasts, the assumptions around short interest rates have fallen reasonably significantly. So notwithstanding the potentially inflationary impacts of tariffs, the market is assuming that central bankers are somewhat going to look through that as transitory inflation and are going to respond to the coming weakness in the economy by reduced interest rates. But that's not really been reflected in the long end of the curve. This chart here shows in pink the US 20-year real yield, and in green the UK 20-year real yield. This was the position at quarter end. Actually, that they sold off a little more, such that the US today sits at about 20 years sits at about 2.6 real, and the UK at about 2.4 real. I'm sure we'll talk a bit maybe in the Q&A about what's driving some of this, but just thinking about the values in the bond market. Clearly, these rising yields have caused some losses in the long bond market. But taking a step back and thinking about values today, they are getting definitely more interesting. The UK long bonds now are above the kind of high yields they hit in the Liz Truss kind of gilt market sell-off. Certainly, if you look historically, there have been not many occasions where if you were buying bonds on 2.5 real yields, long bonds on those kind of returns, that it would have been a foolish thing to do over the life of that bond. These taken standalone, these values are beginning to look much more interesting, certainly than anything we've seen over the last really over the last decade, really going back to the early 2000s. So I think we would say that the repricing in the bond market has moved things much closer to fair value, and indeed potentially interesting value, than the movements in the equity market. So just very quickly, Hassan will talk about the detail, but I just wanted to give you a high-level sense of the changes that we made to the multi-asset portfolios in the quarter. These changes were made ahead of Liberation Day, but with the knowledge that tariffs were coming in and the equity prices were fairly full. And there wasn't a huge change, but essentially we had increased the dry powder weighting, that is the kind of cash, mostly treasury bills and some short high quality credit, up to about a third of the portfolio, which is exceptionally high levels. That was higher than the levels that we had in 2019. It is in line with the levels we've had broadly in the last quarter, but that's really about the highest levels in the company's history. We didn't see the attraction in long bonds yet. They had sold off, but they weren't sufficiently attractive to increase our weighting there. We had somewhat extended the duration of the index-linked bond portfolio, but we had not increased overall our exposure to index-linked bonds. We've been increasing our dry powder holdings by selling down our risk assets. 6 months ago, these were at about 35%. We have reduced those down to about 30%. Actually, in some ways, the weight is a little lower because we've had for example, some bids in the portfolio that, well, we hope they're going to close, but there are a number of assets in there that were not exposed to the full equity market volatility. So we had taken some action ahead of the foreseeable disruption from tariffs, which has meant the portfolio was in reasonable shape to face some of this volatility. But to cover that in a little more detail, I will now hand over to Hassan.
Thanks, Alistair. Right. Whilst all the positioning decisions we made were sensible, in hindsight, as with all these things, we wish we had done more of the same. I will, of course, talk about the quarter, but it would be remiss of me not to discuss what has been an exciting week post-period. So I ran the numbers this morning to include the latest data and performance to take stock. So how did we do? Did we protect capital? Largely, yes, if you would allow us to say that with a thick pencil. The bonds punched back, delivering positive returns for the period, and the largest of our risk asset allocation was to the UK, which fared a bit better. And of course, some of this drag on performance has been from catching a falling knife, as we averaged into positions that looked cheap and got even cheaper. So if my memory serves me correctly, actually, we had 8 to 10 different positions on Friday and a similar level on Monday. So in summary, we've put some money to work, but suspect that we will get more opportunities to do so. And our pencils are sharp on a few names that are on the shopping list. So let's review the last quarter to see what's under the bonnet and the type of opportunities we have invested in and that we like. Let's just touch on the asset allocation. I'll make a few additional points. On dry powder, it is at historical highs, and within this, the composition has not changed. We reduced credit last year, and credit is roughly 2 years in duration, and a meaningful portion of that is index linked. And this was rather helpful when credit spreads blew out very sharply last week. Within index linked, the overall allocation has not changed, but the composition has. We sold down some of our short UK index linked in favor of hedge tips on better values. And we removed the barbell on the tips as the real curve slope steepened and extended the duration modestly to 8.5 years. Within risk assets, we reduced these by about 2% early in the quarter, and even more meaningfully so since the last quarter. And really, particularly, we did that in US equities. So two of our largest sales were PCFT and RIC Capital Partners. PCFT I'll discuss, and RIC Capital Partners at its peak was 80 basis points of the portfolio. We did a deep dive into the private equity space, and our conclusion was that there was not substantial evidence, at least in January when we looked at it, to support the level of realization and M&A activity. So, risk assets were reduced heading into this, particularly in the US, and all those choices at the margin were helpful. Now, both our bonds and our equities have contributed to some of this relative outperformance. And as you can see, our risk assets had a particularly strong quarter, which I think brings out three choices. Number one, our geographic overweight to the UK, which did better as a market. Number two, our stock selection capabilities within investment trusts, which meant that we delivered strong relative performance, even in falling markets such as the US. And number three, our sector allocation to infrastructure, which had a lower beta in the sell-off. So I'll go through a couple of examples that demonstrate this. One positions we've exited is Temple Bar. Now, this is essentially a collection of UK equities that are buying back at a record pace in a vehicle that has a 6% promise on its discount, and it is buying back at a record pace to defend that. So it is in a market we like, and in a wrapper that is powerfully accretive to returns as well. And you could see in green our entry points and our exit points, but really it speaks to both our choices in the UK and also how we manage these positions as their values become less attractive. Another example of is PCFT. Now, Polarcap Global Financials is a global financials investment trust. And the interesting thing to know about it is that it has a 100% tender this summer. So the discount opportunity when it was around 10% was quite attractive. We built that position to almost a peak of 1% of the portfolio, and exited a substantial portion of it at the all-time peak as well. So I think what this speaks to is both our acuity in investment trusts and our ability to select stocks that we think will outperform both on a relative basis and on an absolute basis. And finally, our sector allocation to infrastructure was helpful. Now, if you've attended the past few quarterly webinars, you'll recall that we were adding to the sector at the end of last year after a significant sell-off, and really the sector has derated off a combination of technical selling from multi-asset funds and rising yields, and there is a huge disconnect between public and private valuations in the space. Now, I have to say, we don't necessarily agree with all the NAVs. I think they are more art than science, but the discounts in the sector are really astonishing, and I think there is margin for both safety and outperformance in there. BBGI Infrastructure is an example of one of our holdings, one of our largest holdings, and this was recently bid for by the Canadian pension fund BCI. So to summarize, I suppose our allocation, our geographic allocation, our stock selection within markets, and our sector allocation were all reasons that we were able to contend with these markets and perform better against the investment trust index. and broader markets. Now, there is of course, a lot of uncertainty, and in a world characterized by trade wars and an ailing labor force and large and productive defense spending, it's likely to be more inflationary. And the Fed will have a careful balancing act between avoiding a recession and maintaining credibility around inflation. But what is more clear is that the uncertainty premium tied to Trump's erratic political leadership isn't going anywhere, and it will come at a cost. So what I hope our recent response, and our track record over the past 4 decades shows is that by avoiding the worst excesses of the market, we can sidestep the harshest drawdowns, using them as opportunities to deploy dry powder on commanding terms to extract strong risk-adjusted returns. Over time, these returns should compound away reliably, and we hope outperform equity markets, but crucially with lower volatility. So we back the tortoise over the hare any day of the week, especially last week. I'll hand over for questions.
That's great. Thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do so just by using the Q&A tab that's situated in the top right corner of your screen. As you can see, we have received a number of questions throughout today's presentation, and Sophia, if I could hand over to you to chair the Q&A, that'd be great, and then I'll pick up from you at the end.
Brilliant, thank you. Yes, we do have quite a few questions, and this one that we've been asked a number of times, given the view that US government bonds has been a low risk asset or a safe haven asset, and we're obviously invested in that, can we discuss whether that view is still intact? I think I'll hand that over to Alistair.
Yeah,
Something
I think
people are thinking about.
Yeah, I think there's a few different ways in which this has been discussed really over the last quarter. Obviously, in relation to tariffs, there's a sense of the reliability of the US as a kind of security guarantor for Europe and the world. So just a kind of general kind of loss in trust. And also there was quite a lot of discussion about a month ago before Liberation Day took over about something called the Mar-a-Lago Accord, and whether there might be a move afoot to essentially default or somehow force investors in US Treasuries into either longer dated or lower yielding securities, or both. So, I mean, it is hard to say that there has not been some loss of faith in the US, particularly on behalf of a number of its European and those that sit under its defence umbrella. But we don't really have a high level of concern around the reliability of the Treasury market. If we step back a bit, I mean, these events are clearly very dramatic in one sense, but there have certainly been plenty of similarly dramatic events in the past. Clearly, I guess Nixon taking the US unilaterally off the gold standard and imposing tariffs would be one example. There's we just don't think ultimately that the US, Donald Trump is clearly a very energetic individual, but there are sufficient controls around him that mean he cannot simply do whatever he wants. And there is a sense really after the chaos of Liberation Day that resistance is starting to build internally. I think the impact of a kind of default and for sure, some kind of forced change of a bond, some short bond into a 100-year bond with a low coupon or whatever the Mar-a-Lago kind of idea was. For sure, that is a default. I think that that is not something that President Trump could unilaterally do. That is what, and I do not believe it's something that Congress would allow. I do not believe that the US is going to default on its debt. I mean, why would it? You can always create the dollars to redeem its debt. So we still think that the credit risk is incredibly low. There is a risk that all of these activities could result in higher inflation. But that is what you get from the inflation protection with an index-linked bond. So what I would definitely say is the relative attraction of UK bonds has increased. That's largely due to the fact that they've sold off more markedly, and we're definitely looking at that market pretty closely. Having had a big weighting to the US over the last quarter, we're looking increasingly to the UK now. But we do not have a high level of concern about some kind of default event by the US Treasury.
The only thing I'd add is that the technical backdrop this week is fascinating. You've got a pretty large supply of nominals coming on. It's at the upper end, and you combine that with a lot of the basis trade unwinding as well. So there is a lot of nervousness around this auction, and you could see people de-risking. So some of the technical backdrop is causing quite outsized moves, and that's contributing to this. On the Accord itself, I think I'm really skeptical of this because I think an outright default, forcing foreign holders of moving to 100 years would be close to an outright default, and the consequences for the repo market will be huge. And it really depends on what they want to achieve. If it's to weaken the dollar or lower interest rates, there are other ways to go about that. Whether they charge a user fee, that's or a withholding tax that's been circulated, and really, why would foreign holders pay for that, right? To accept lower returns. Is it better security guarantees? Well, that's not worth very much to the Chinese or increasingly to the Japanese. They can walk with their feet. They can now buy some German debt or some more gold. And they've stated that this isn't a policy priority. I think the paper by Miran got a lot more traction than even he was expecting. The policy priority they've mentioned is tariffs, but I agree that the talk of these, all other things being constant, may push up yields, but is all very speculative at this stage. And I think the recent moves that we've seen are an expression of the de-risking and technicals as much as some of these more strategic macro-driven moves.
Great, thank you both. Well, we've got a mix of questions here, quite a few around Trump, obviously. But I'm gonna, Hassan, I think, come to you around a slightly different topic. So someone has asked about the attractiveness of renewable infrastructure, and are we or have we been adding exposure here? I know you touched on it in the slide before the one that's currently on the screen, I think. But maybe we could talk a little bit about where we might be adding within the risk assets, and if we expect to do so more.
Are we adding to renewable? Short answer, yes. And we'll let you know when we build that position. This is another interesting area because by way of background, I've I started my career doing infrastructure M&A. So, I look at these assets on a fundamental basis, and you can value them a few different ways. You could look at a DCF, you could look at transaction comps, you can look at PEs, and however you triangulate this stuff, they look incredibly, I wouldn't say, they look incredibly cheap, but with the caveat that we place significant haircuts on the NAV, and somewhere between their current price and their NAVs is the correct answer. But some of these names are trading as if the sun won't shine tomorrow and the wind won't blow, and between that there is an interesting answer. There are contractual, largely index-linked cash flows for some of these trusts that go out to 10 years. The balance of the merchant exposure can be heavily discounted. And you've got to think about three key factors, right? You've got to think about your generation assumptions, your inflation assumptions, and your, the capture rates that you're incorporating into these things. And you could stress them a few different ways. And so, the answer we get to is, on a fundamental basis, these are probably quite attractive, but so what? How do we make money from this sector, and over what time period? And that's the more interesting piece for me. I think that we're going to see a level of engagement in this sector ahead of continuation votes and afterwards that is going to put the pressure on, and is already putting the pressure on some of these trusts to dispose at an even more accelerated rate. Some of these trusts are buying back, I think, at least 7% of their share capital in the last 12 months, and they are accelerating their disposals. So, whilst you get a decent return for just holding them, if we can engage with these companies to accelerate those returns, then that's even more sensible. And we're doing that. We are sitting down with other investors, and we're marshalling together constructive conversations that I think will over time yield good, reasonable outcomes. So it's, to summarize, we like the assets, and having some agency over driving those returns through engaging with these companies in an outcomes-based environment where we think we have reasonable confidence that we can get a good outcome. Those two things for us make these an interesting sector. And so we are adding selectively to very specific solar funds and infrastructure funds.
Brilliant. Thanks, Hassan. Alistair, I might come to you for this. We've had quite a few questions around current uncertainty and implications for physical gold. We have a position in gold, I think around 1%. One of our investors has noted. Will this be increasing? Has it increased? Are we looking at increasing it? And would it be more appropriate to have a larger position? I've combined a few questions there for you.
So the answer to whether it will be increasing is no. We have historically always had pretty low weightings to gold. It is an asset that has a low level of correlation to a variety of other assets. So it does have some use in the portfolio. It's been around for long enough. People have attributed value to it for long enough that they are likely to continue to do so. However, we find it incredibly hard to analyze on any fundamental basis. It has no cash flow attributed to it. So, I mean, the short answer is it's had a phenomenal run over the last 12 months. We obviously regret that we didn't have more, but we didn't have the capacity to analyze that ahead of time, and nor do we have the capacity to analyze it going forward now. So it's going to remain a small part of the portfolio.
The
Oh,
only
sorry,
thing I'd
Hassan,
add
go
is
ahead.
the historical relationship, if you, regressing gold to real interest rates and the dollar and those for a period of time when were overwhelmed by the structural demand by central banks for gold. And so what that relationship looks like in the future, the weightings of each of those factors that explain the price of gold, there's a question mark over those, and the level of confidence we have. But the level of volatility that the gold price introduces into a portfolio isn't consistent with a wealth preservation mandate. And so we reduced some of our gold holdings in the last quarter before Liberation Day, and where our analysis showed that what was driving the price potentially was fear, and when fear is most acute, we took some of those gold profits and we're pleased that we were sold at the all-time high, and but introducing a larger share of gold is, I think, inconsistent with some of the wealth preservation credentials and volatility credentials that you would expect.
Thank you. And we have quite a specific question here about at what GRY would you consider buying a 30-year gilt? And they have offered 6% plus.
A 30-year gilt, sorry, was that?
Yes.
Well, to be honest, I'd certainly think about it at 6, but we'd be much more likely to be buying index linked. I just don't know, unless the break evens were incredibly expensive. I have no idea why you'd buy a 30-year instrument without index linking in this environment. But if we flip that into real yield terms, we're at 2.5 now. We have bought some longer. We do have a small holding of essentially 30-year gilts in the portfolio. I think if that were north of 3, I think essentially a 6 on the 30-year. Break evens at 2.5. If you're talking kind of 3.5 real yields, then yeah, we would I think almost certainly be adding there.
Great. Actually, just leading on from that, someone has asked about the weighted average maturity of our bond portfolio. I wonder if we could touch on that as well.
I think if you look overall, and Hassan, do correct me if I get this wrong, but I think if you look overall at our entire bond portfolio, including our dry powder, that our duration is around 4 years. With obviously in the dry powder bit, the duration is much shorter. The index linked duration, where we hold most of our duration, is about 7.5 years. With the and the tips, our holding is about 7 years duration. That's the biggest bit of our index linked portfolio. So given the current sell-off in bond markets, I would imagine, if anything, that would lengthen, but I don't think in a very dramatic way.
Yeah, it's a turn in the UK, and I'd say that sounds about right. 8-ish in the tips. The only change of note to remember essentially is we removed the barbell positioning in the last quarter to reflect the steepening at the belly of the curve, and overall those duration numbers sound about right.
I think this would make sense to go on to next. We've had a couple of questions on currency hedging and currency hedging risk. Is this a key strategic issue, and can we have a little comment on that?
Sorry, is the risk of currency hedging a key strategic issue? No, I don't think it is. Essentially, as we look around the different markets, essentially all the currency hedging is occurring within our dry powder portfolio. We are very happy to hold UK Treasury bills, but if we can get higher returns by holding a 6-month Japanese Treasury bill hedged back into sterling, for example, then we will do that. I don't think the risk associated with a 6-month sterling yen currency swap could be considered a key strategic risk. And I think the currency market, short-term hedging through the currency market must be about the lowest risk part of the derivative markets we analyze it.
Great, thank you. I'm going to have to come back to Trump. There are a couple of questions. I can't avoid it, I'm afraid. A couple of questions around people being concerned about the confrontations between Trump and Powell, risks of a Trump takeover of the Fed, and what he might do to a successor at the Fed.
Okay, well, the first thing to note is that Powell is a card-carrying Republican that was put into his role by Trump. So, the second thing to note is the President of the United States does not have the power to sack the chair of the Federal Reserve System. Powell is coming towards the end of his term, and I think it's unlikely that he will be his term will be renewed. So we'll have to see which candidate comes up. But I don't think that Trump will be capable of completely taking over the Federal Reserve any more than he already has, by putting in Powell in the first place. So that's not a principal concern, no.
Great. A term I quite like from one of our clients asking a question, the Trump slump. So are we looking at this as an opportunity to deploy some of our dry powder to buy more risk assets, and perhaps where we might be looking, which sectors, etc., is where we might be looking to do so if we are doing that?
We are deploying some dry powder. We are doing so where risks are asymmetric and returns are exceptional, and particularly doing so where we have some agency over the outcome. We can drive and pull those returns towards us. Given the uncertainty now, I think will be that is going to be embedded in the flip-flopping of policy. I think how long it takes for tariffs and the uncertainty to cascade through markets, there's a question mark over, and that's a risk we have to factor in. Where we feel we have sufficiently compensated for some of those wide spectrum of outcomes, and returns look exceptional, and we have some agency. So we are adding. Which sectors? As you know, we're adding to infrastructure, some core and some wind. I should have said wind, not solar. And we're looking at investment trusts. We have a long shopping list of investment trusts that are interesting. We're avoiding private equity, where a lot of the upside was priced into realization and M&A activity, and that doesn't look like it's coming through, and nor is the capital allocation side of those cash flows necessarily going to deliver investors from both a falling NAV and a widening discount. So we're avoiding that sector. We're looking at infrastructure, we're looking at conventional equity, and really there's quite a wide breadth of things where we've sharpened our pencils, and we will update everyone in due course once those positions are established.
Great, thanks, Hassan. Actually, while we're on investment trusts, someone has asked, does the size of the trust limit our ability to invest in smaller investment trusts that perhaps could offer stronger returns?
I don't think so. No, because we track. We have quite automated systems to look at. I'd say a wide breadth of the investment trust sector space. I like smaller trusts where the position size that we have can provide us with a level of influence, particularly if the register turnout is poor, and then allows us to shepherd that trust into better governance. And then I think on liquidity, we need to think about how we frame liquidity. Liquidity isn't just the daily traded volume. There are a range of tender mechanisms being put in place. There is a range of tender mechanisms coming up this year that give us 100% redemption. So, where we don't already have liquidity, we will try to create some, and where we do, we can right size that position. So, there are 370 trusts, and about 125 are less than 400 million. There's plenty to go after, and on average, the discounts are wide, and on average, this is a sector where we've consistently delivered alpha. So on average, we hope to outperform, and the opportunity set to do so has improved.
Great. We've got a few more questions. We are working our way through them. A yes/no answer to this one. Do you expect to pay a special dividend this year?
I don't think so, no.
There we go. And now a slightly longer answer for this one. So there are a couple of questions around performance. One specifically us versus Ruffer. They seem to be outperforming us, and what are they doing differently? I think we can sort of touch on that briefly. But equally, another question around the fact of we have obviously been skeptical for a while, and one investor asking why that perhaps hasn't translated into better performance. I imagine that means over the past couple of years. I'm not quite sure. They haven't specified, but maybe we could touch on kind of recent performance.
Okay, so to take Ruffer at a high level, they have they make much greater use of derivatives in their portfolio. Essentially, if you step back from the current, if you step back and look at the key areas of the current market, for a sterling long only absolute return investor, sterling has been kind of up and down a bit, but with generally kind of firmish. Long bonds are going up, i.e. bond prices are going down, and equity markets are going down quite fast. So there's not a lot of obvious places to make significant gains unless you're in the derivative market. That's not an area that we have a lot of exposure to, and I would imagine that's where Ruffer is deriving some portion of its recent strong performance. We do actually hold Ruffer Investment Trust in the portfolio, so we've benefited from that and a narrowing discount. So that has been helpful in terms of our defensive positioning. What it has allowed us not to suffer any drawdown of any meaningful amount in this quarter, which has obviously been helpful. Where it wasn't helpful was, say, last year, where the equity market was, very, performing very strongly. So yeah, we've not captured the downside, and I guess we've only captured a small part of the upside of the equity market last year, but that is the nature of you know.
The only thing I'd add to buffer is that there's many ways to achieve wealth preservation, and we prioritize the volatility of those returns and the range of those drawdowns as much as the absolute returns that we get. So, compared to our peers, we have we have the lowest drawdown experience, and the lived experience of our investors over that journey is just that one of lower drawdowns. What they do is differently. They have CDSs on credit spreads. They have puts on the S&P. They have significantly more China exposure and gold exposure than us. In aggregate, what that leads to is just bigger swings over that time period, and so a greater emphasis on timing. The other thing that's happened is the discount has come in, and credit to the board, they've moved the discount from 7 to right into 4 if I look this morning, and what you tend to see is a response where it might swing from a discount to a premium. So but equally it has gone the other way. So the point being that journey on at least on a price basis is more volatile. But we feel that for a wealth preservation mandate, as well as being able to punch back when markets are down, we should be first and foremost preserving capital and then deploying our dry powder on exceptional terms so that it can reliably continue to outperform and not concentrate on timing of the market, because the drag on performance net of fees and all those costs is just not something that we can do with any level of acuity as potentially some of our peers, and it's one of that.
Brilliant. Well, I think we have been just over an hour, so I'm gonna call it there. And thank you so much for your questions. I think there are a couple that we haven't answered yet, but we can answer those post the event, and I believe they will be posted on Investor Meet Company afterwards. But equally, do get in touch with us if you have further questions. We're happy to help. Alessandro, I think I'm handing back to you.
Yeah, that's great. I'd just like to thank you all for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but some shall be greatly valued by the company. On behalf of the management team of CG Asset Management, we'd like to thank you for attending today's presentation, and good morning to you all.